Okay, great. So thanks so much for including the paper on the program. This is a paper about concentrated liquidity. So we're going to get a little more specific on the sort of Uniswap kind of V3 model on how liquidity is provided. Okay, this is joint work with Joel and Fahad. So it should be very clear by now that a decentralized exchange is a place you go to on the blockchain that allows you to swap crypto assets for crypto assets or token A for token B. And in this paper, we're studying this new feature that was introduced in Uniswap v3 called concentrated liquidity. Basically, I'm going to go into this in detail throughout the talk, but concentrated liquidity is differing from version 2 in the sense that it allows you to provide liquidity which would be available for trading use only when the price of the underlying assets lies within a particular interval, or I'll call it a bin from time to time in the talk. Now, the goal of introducing this new feature was to allow for more efficient use of capital when you provide it as liquidity. Again, I will talk about why this is the case, but in general, the concentrated liquidity very much achieves this goal with the caveat of making it much more complex to provide liquidity on these decentralized exchanges. So this sort of motivated us to kind of build a model of a decentralized exchange with concentrated liquidity. And we want to study the economics of liquidity provision in particular in order to generate sort of what the optimal distribution of liquidity provision across different prices should be in equilibrium given the features of the price process. Okay. In doing so, in characterizing this sort of distribution of equilibrium liquidity, we're also going to be studying and sort of generating some of the trade-offs that these liquidity providers face when they provide liquidity to a particular price interval, hopefully to create some insights that practitioners can use to understand sort of the risk-return trade-offs they face when they provide concentrated liquidity. Okay, so what's the difference? So when we had uniform liquidity, the idea is the only decision variable you have is you provide liquidity or you don't provide liquidity. You add liquidity, you remove liquidity. Once you provide it, that liquidity effectively gets spread out across all of the prices. So the idea is that even if the price moves a lot, if the, let's say, Ether price moves to $1 million tomorrow, some of your liquidity will still be there available for somebody to trade with at that $1 million price. Now, the problem is it's very unlikely from now until, let's say, the end of today that the Ethereum price reaches $1 million, which means whatever liquidity is sitting out there is not going to be used with a very, very high probability, almost certainly not within the day. Okay, so this means that liquidity gets wasted, right? So when I provide $1 million, it gets spread across all the prices, and there's so much waste happening, especially if you think about stablecoin pairs. Okay, now for concentrated liquidity, I'm going to specifically choose a price interval, $1,000 to $1,001 for the ETH USDC price. Okay, and I'm going to provide my liquidity there. Then once it's provided, it's only active to trade against, like I said earlier, once the price is within that range. When it moves to another range, there's going to be a different set of liquidity that you get to trade with, but it might be less or more, and that's going to have some implications for price impacts. Okay. Now, in both cases, the pricing is going to be a mechanical function of available liquidity. The difference is that with uniform liquidity, it's just the total liquidity in the smart contract. With concentrated liquidity, pricing is going to depend on the bin through which you trade. And I'll explain how that works later. Right, and in both cases, this is very much a peer-to-pool system. So if you're thinking, oh, this is just a limit order book, I'm going to point out some differences. This is the first one. The idea is when I provide my liquidity, there's no timing. So in a limit order book, when I provide a bid, right, there's also a timing. So we can have the same price, but I could have arrived first, and whenever a trade happens, my bid would get picked up before yours. In this case, that's not going to happen. All the trading is going to happen pro rata. So, if the trade uses 1/10 of the capital and I provide half, then, basically it's going to take 1/10 of mine and 1/10 of whoever's providing the other half. And same thing with the way that the fees are earned. The fees are paid pro rata to the liquidity providers in the pool to which the price is trading. Okay, so just to give an overview of the results, right? We're modeling this DEX. In particular, we're going to look at a DEX that's using trading a pair of assets. So it's a risky asset, which we're just going to call ETH, and a stable coin that we're going to call USDC. Okay, but we can adopt this for a stable coin, or risky asset pair. But this is the framework that I'm going to be presenting today. So as far as the preliminary results, we're going to talk about this idea that providing liquidity to a specific bin is sort of equivalent to investing in a dynamic portfolio where the underlying assets are the assets in the pool that you provide liquidity to, right? And as this portfolio evolves over time, it's going to sustain losses due to this arbitrage activities. This is exactly the loss versus rebalancing that Siamak and co-authors are characterizing. But there's also some risk that comes with the fact that the inventory that I provide may not be the inventory that I redeem at the end of the day. And so there's going to be some issues with kind of the returns that are implied by this, okay? So this is just thinking about the returns on the underlying inventory, but then you're also going to have sort of a dividend that gets paid, a random dividend that's get paid, which is the fee revenues that you're going to earn. Okay. Okay, so now just coming to the main results, as I said earlier, we're gonna determine this liquidity provision distribution in equilibrium. We're gonna have a nice approximation that will allow all the theorists to do comparative statics and empiricists to use it maybe more cleanly to identify some things. And then, yeah, we can also talk about things about how these returns evolve and their relationship to certain covered call strategies that I probably won't spend too much time on with this audience. Okay, so just getting to the model. So you have a decentralized exchange. Now with concentrated liquidity, you're going to partition the exchange into many different price intervals. Right now, it's like roughly 1.6 million price intervals. So for notation, just the price interval length is delta. And so psi I is going to be the lower price of bin I, let's say $1,000. And psi I plus 1 is going to be the upper price, so let's say 1,001. So if I provide liquidity to that bin, I only earn fees when the price trades between $1,000 and $1,001. Okay, now liquidity providers, they can select any subset of this 1.6 million bins to provide liquidity to, and the liquidity is going to be provided as ETH USDC, and it's going to depend on the underlying price, what you actually provide liquidity as. I'll give you an illustration for that in a little bit. Okay, so we're taking a kind of simple approach here. We're going to say there's a single investment horizon. So if you want to be serious about this, you could say T is just 12 seconds, okay? And we're going to re-update our liquidity every 12 seconds. Of course, that runs into problems if you consider gas fees, which we're abstracting from. So we're just going to think of this kind of like in a general case. Let's just look at what liquidity would be if there was no rebalancing from time 0 to time T. So at time 0, all of the investors are going to decide to provide liquidity if doing so is profitable, and then they're going to take the rest of their money and spend it elsewhere where they can get some other returns. From time 0 to time capital T, then we're going to have liquidity traders arriving who are going to randomly trade with the DEX, and then we're going to have arbitrage traders that are basically going to make sure that that DEX price is always going to be realigned with some fundamental price that I'll tell you how we're thinking about it in the next slide. Finally, at time capital T, the liquidity providers, they're going to basically redeem their liquidity and they're going to realize their gains or potentially losses from the trading activity. Okay, the results here are basically derived through no arbitrage conditions. So we're agnostic to risk preferences. If we include risk preferences, that might change some of the model, but the nice thing is that it doesn't change the underlying distribution, equilibrium distribution of liquidity. So again, I think it's well suited for empirical work. Okay, so here's how we're going to think about price dynamics. We're going to take this sort of generalized diffusion process. So the price, the fundamental ETH price denominated in US dollars is going to evolve according to this equation. R in this case is going to be the risk-free rate because we're thinking in kind of a risk-neutral world. Sigma T is going to be the log return volatility of the price, Ether price. Okay, so now the conceptual exercise for a liquidity provider here is to say, let's say yesterday I was looking at ETH prices. This is not actually ETH prices, it's something I just simulated. But let's say I see this pattern for prices yesterday or over some time series. Now what I'm going to do is I'm going to say, okay, these prices over the day, it's going to map to a sort of histogram across the bins of where the price was trading. So this is telling you what's the frequency with which, given this price path, the price was trading in each of these bins, and this is going to be proportional to the fee revenues, which is going to be multiplying this by some constant. Okay, so now I'll say, where do I want to provide liquidity? Well, if I knew the price was going to go across this path, I'd provide more liquidity here, less liquidity there, etc. But what's more difficult is now anticipating what's going to happen tomorrow with this price path. So I'm going to form a belief about the risk-free rate. I'm going to form a belief about volatilities tomorrow. And I'm going to try to target where I think that the price is going to go, subject to the caveat that all the other liquidity providers are thinking the same way. And if too much of us provide liquidity to a bin, we're going to earn too little of the fees because of this pro rata nature of the fee sharing. Okay, so regarding the traders, we're kind of keeping it very simple on this side. So the liquidity traders, we're going to think they just have sort of an exogenous flow of trading volume V per unit time. In principle, I think it would be better to think of V potentially as a function of the underlying inventory, and we could do that and still generate the same results. For example, you can have some convex function of inventory. The reason why this would be interesting is because inventory under constant product automated market makers is price impact is a function of inventory. So if you have more inventory, you have less price impact, and that actually might incentivize more trading if you had a more micro-founded model of these liquidity traders. Okay, yeah.
So is the right way of thinking about the trading volume is that there's just an equal amount bought and sold at every place?
Yes, exactly. Yeah. They're basically offsetting because it's happening very fast and there's many trades, but this is like simplifying it. Okay, so right now the arbitrage traders, their job here is to make sure that the underlying price at the DEX is aligned with the true fundamental price, and we're going to assume that they just have that information. We're not gonna say how they got it. Okay, yeah.
This alpha is between 0 and 1. So the question is, alpha is between 0 and 1?
Yeah. Okay. Yeah. I mean, there should be some limits to how much the inventory actually affects trading volume. You can imagine if inventory explodes, it would be weird that trading volume just explodes because there has to be some underlying demand, right. Sort of like fixed demand for trading, and you'll affect the marginal trader when you lower the price impact, but it should have some limits.
So say that, is it critical or is just need a concave function of the inventory? If the volume is a concave function of the inventory, would it work? Your analysis?
Yeah. So this functional form here, we could get all the same results using that. Okay. We didn't do it in the main exposition. Yeah, exactly. Because we didn't want to take a stance on what that functional form should be, but I'm very happy to brainstorm about that. I think it's an important question for future work. Yeah. Okay, so now I want to talk about pricing and I want to talk about inventory. So how you supply inventory to these smart contracts. It's very easy to start with the uniform case, and then I'll go to the concentrated liquidity case. So in the uniform case, you have a DEX is a collection of liquidity pools. These are always pairs of tokens. So here we're thinking ETH and some stable coin denominated in US dollars. So it starts with the uniform pricing, the old version. The liquidity provider is going to start the DEX the liquidity pool by providing equal dollar amounts of ETH and USDC given the current price. Okay. Now, once that inventory is there, liquidity trader comes along. This liquidity trader wants a certain amount of ETH, delta ETH. They're going to pull that out of the pool. They're going to have to pay for it with a price delta USD. How is that determined? We've seen that enough today. How is that determined? It's by this constant product automated market maker. The product of the inventories before the trade should be equal to the product of the inventories after the trade. So if you tell me you want delta ETH, I can just solve this equation for delta USD. That's the price you're going to pay for that ETH, right? And this is the effective exchange rate, which is basically getting worse and worse as you start pulling more and more out of the pool. Okay, sorry. Last thing is every time these liquidity traders make a trade, they pay fees to the liquidity providers, and that's the incentive for providing liquidity. Again, unlike a limit order book where you're not typically earning fees as a liquidity provider, right? That's really what's driving the incentive here. Okay, now when we come to concentrated liquidity provision, now liquidity provider I is going to decide to provide liquidity to bin I. Okay, and so the question is, what inventory do you provide? I think this will just provide some good context for the design. So it depends on the current price. So I'm going to look at, let's say, the Binance price, and I'm going to say, is it below my bin? If it's below my bin, Uniswap is going to ask me to provide only ETH inventory. If it's in my bin, the price, then Uniswap is going to ask me to provide equal dollar amounts of ETH and USD. And if it's outside my bin, Uniswap is going to ask me only to provide USD. Now, when you think about this thing I was saying earlier about a dynamic portfolio, right, this is how I provide liquidity, but this is how also my claim on the underlying inventory changes with the price, okay? So if let's say I started and I provided only ETH inventory, and at the end of the day, the price ended up somewhere in my bin, I'm gonna get less ETH than I provided, and I'm gonna get some USD, okay? If I started and I provide ETH inventory, and then the price ends at the end of my bin when I redeem, I'm gonna be redeeming only USD. Okay, so I think this is sort of an important institutional feature about concentrated liquidity. Okay, so now same thing when the liquidity trader comes along, right? They're only trading with the active bin, okay, and so they're going to come do the same thing. They're going to pay fees only to the liquidity providers of that bin that the price is trading through. If you move through multiple bins, it's sort of like a piecemeal thing where you're making the trades bin by bin and fees bin by bin. Okay, so the last question now is, well, how do you determine the price here? In the old version, if I take all the liquidity out, this is a very bad thing. I would never be incentivized to do that, but we actually want to allow you to take all the liquidity out so we can move you to the next bin. That's sort of the requirement. The liquidity has to be depleted in bin I before you move to bin I+1. So it's a similar functional form as the uniform liquidity, and it's a very simple change, which is just you're adding a sort of constant to the actual liquidity in the pool for both assets. The constant is different for the assets for sort of different reasons, but the idea here now is iETH is the actual inventory, and then iETH plus this constant is going to be the virtual ETH inventory, and then the constant product automated market maker works exactly the same as before. It's just now we want the product of virtual inventory to be the same before and after the trade. So you tell me the delta ETH you want, I can tell you exactly how much delta USD you're going to pull out. The important thing, LI here is endogenous in the sense that it depends on the amount of liquidity provided to the bin, but you know that before you start trading with the bin, so you can figure out exactly your pricing. But it's going to change with liquidity. Okay, so when we're thinking about providing liquidity to bin I, right, so we're going to call pi IT the value of the liquidity in that bin at time t. So in bin I at time t, that's just going to be however much USDC is there plus the ETH times the price. This is the dollar value. Okay. Now the liquidity providers, their returns from providing liquidity, this is important. They're going to have sort of two components. So the first one is they're going to get a return on their claim on the inventory in the pool. Okay. And this is actually going to be sort of a losing return for them. This is like a sort of I'm talking about impermanent loss, but now it's sort of a more generalized version for concentrated liquidity. But the idea is the inventory I put in is not necessarily the inventory I get out. So there's going to be some return I earn depending on the change in the value of that inventory that I provided to the inventory that I redeem. Okay, and then you're going to get a pro rata trading fee return. And this is the lever that allows us to ensure that, you know, we get a nice equilibrium, because basically when the return is too low, all that's going to happen, phi here is going to be a constant when we make this assumption about constant flow, then basically all that needs to adjust is the amount of liquidity in the bin to cause the return to go up or the return to go down to make sure we're getting the right return compared to our outside options. Okay. Okay. So when we think about the sort of risk-adjusted returns from liquidity provision, the equilibrium equation is basically just to say that my expected return from providing liquidity to bin I is just equal to the risk-free rate from the risk-neutral perspective. Okay, and then you can solve this, and you get this sort of very opaque equilibrium equation for how liquidity in bin I should be provided, depending on the expected fee revenues in bin I, and depending on basically the loss that you're going to earn on the fact that your inventory is being traded after you provide it. Okay, then you can solve for RPLI, and just now that we have the notation, right, this liquidity measure is basically proportional to the dollar value of the underlying inventory. Okay, so quickly my preliminary results. So basically, liquidity provision is equivalent to investing in a dynamic ETH portfolio. This is very much mechanical, right? You're going to have a weight on ETH omega I. It's going to be decreasing in the ETH price. So the idea is when the price is trading through your bin from below the bin to above the bin, you're trading away your ETH and you're getting more and more USDC, right? And then in the flow sense, you're also going to have this sort of loss versus rebalancing. That's the LI that you're going to lose per period of time because the arbitrage traders are coming along and sort of picking you off when your prices are stale in your bin. Okay, so now if we think about the opportunity cost of liquidity provision, so let's start about thinking about it without fees. So assuming you're not earning fees, just thinking about the return on that underlying inventory. Basically, in that sense, if there were no fees, you would, if you had to provide liquidity, you would want to provide it as far away from the money as possible, right? And the reason for this is that, again, every time the price trades through your bin, you're getting exchanged for the assets that the price is moving, in the good direction for, right? So you're giving up ETH when the price is going up, and that means when the price trades through your bin, you're losing all of the potential upside return that you would get on ETH, right? And the same thing when it comes down through your bin, now you're giving away your USDC, you're in exchange for ETH, but that's precisely when the ETH price is dropping. So you're accepting the downside of the ETH when you provide liquidity here. Okay, so this helps us sort of frame the main trade-off, which is that in principle, you want to provide, like I was saying earlier, inventory in bins that are very close to the price, because the only way you earn fees is by when the price trades through you, and over any period of time, the price is more likely to trade through you when you're close to the current price. Okay, so you want to be close to the bins, but the problem is that the opportunity cost that arises due to price fluctuations of the underlying assets and the change in the value of your inventory, you're basically more likely to incur this cost the closer you are to the at-the-money bin. So basically, the liquidity provision is the lever that's going to adjust to make sure that the fee revenues I'm getting in any bin is exactly offsetting the opportunity cost of allowing you to trade with my inventory in that bin. Okay, so here is our basically approximate equilibrium liquidity provision formula. So this is because of the fact that this formula I showed you earlier is very much opaque. So we like this formula. This is misleading. You don't need a non-stochastic volatility. It's just with non-stochastic volatility, we know exactly what these function F are, these distributions of prices over time. But you could use basically any some general diffusion process, and you just have to, the hard part empirically, I guess, would be figuring out what the distribution is, but you could always simulate. Okay, so now you get this. So what we're doing here is we're scaling the liquidity provision in equilibrium by 1 over the bin size, and we're taking the limit as the bin size goes to 0, and that gives us sort of this continuous liquidity distribution pi of p. So you give me a price, and that's going to basically approximate how much liquidity will be at that price. And the approximation is actually much more simple, where you just say, take a price in your bin, right? Plug it into this function, and the equilibrium liquidity should be approximately that times the bin size. Okay, and if the bin size in practice is small, which it is, but small is more quantitative question, then this is going to be a good approximation. And so again, if you think you can do some comparative statics with this to maybe build on some of the weaker assumptions of the paper. But also, I think this is nice to have this kind of structure potentially for empirical work. Now, again, taking advantage of this approximation, we can also now start to think about the returns. So taking the same limit on our returns as the bin size goes to 0, scaling by 1 over the bin size, we're going to get this nice expression for what our returns look like. And this is very strong similarities to a covered call, the return that you would get from a covered call strategy. So that's basically, I'm going to buy some ETH, and then I'm going to sell a call option against that ETH position with the strike price equal to the price at which liquidity was provided. Okay, so this gives you some understanding, let's say if you're a practitioner, on how to think about the risk of this portfolio or inventory return, as well as potentially thinking about how you might hedge that risk if this is your full-time job. Okay, just to quickly conclude, we're thinking about a model of a DEX with concentrated liquidity. The goal here is to provide some clarity on how equilibrium liquidity provision should be provided in practice, so that you can compare that to what you actually see and figure out if there are any sophisticated investors in this world. And of course, the equilibrium distribution is going to depend on the features of the underlying price process, and that's really the link we wanted to make here. We're characterizing this distribution. We're hopefully providing some useful insights about the trade-offs and the returns features for providing liquidity to any given bin. And again, just to reiterate what this sort of key trade-off is you want to balance the expected fee revenues that you only get when the price trades in your bin with the opportunity cost of having this dynamic inventory position, whereby you're giving up the upside on ETH and you're accepting the downside on ETH when the price is trading through that bin, right? Of course, factoring in the fact that these fees are shared pro rata amongst investors. So if too many investors provide liquidity to the at-the-money bin, for example, the fee return will just be too low. Okay, so that's our lever. Thank you very much.
I have two questions. So the first question is really cool that you guys got a closed form formula. I'm wondering how that compares to actual observed on-chain liquidity. And I would just say that in concert with Philip's observation that in Uniswap V3 market makers do seem to lose money. So obviously your equilibrium condition doesn't hold, but I'm just curious what the shape looks like. That's the first question. Maybe the second question is your equilibrium depends on picking a time horizon. And it's not obvious that there's a natural time horizon. So I'm wondering how you think about that, and also maybe contrast to another formulation where the natural way I think about how you should pick liquidity is maybe a trade-off between let's say it was costless to update your position.
Right.
Maybe you would always track the price, but in reality you pay gas.
Yeah.
And that causes a friction. I think that may be another way to formulate it, whereas it feels like you guys went for more of a constraint on the block of time. So those are two separate questions.
So the second one is a great question, and I have a probably unsatisfactory answer, right? Basically, what we wanted to do with this paper is build a starting point to say if I froze time, and then I unlocked it, what would the liquidity provision distribution look like? Now, much more important would be the practical concerns of, if this is block by block, now I have to pay gas fees, and you're probably not going to see the same distribution of liquidity, but this would be like an upper bound in principle for the equilibrium liquidity, because now when I have to rebalance, basically it's going to lower my incentive to provide liquidity across all the bids. Aside from that, there's really not much I can say other than this. I think would be fascinating future work. I know you have work on thinking about trading with gas fees and how that might impact things. So you'll probably have better answers than me. But we really think of this as a starting point, and from this you can start to build more dynamics on top of it. But it's a great question. As far as the actual, comparing this to observed liquidity provision, we haven't gotten there yet. You guys might know a little bit more about it. Of course, we would probably expect that we're not going to get the right shape. There's a lot of weird things if you just look at Uniswap and now Uniswap, actually one feature I picked up on recently is when you ask to provide liquidity, if you're not a sophisticated investor, what you're going to do is you're going to use their interface. And if you accidentally put numbers that spread you across a number of bins, Uniswap is automatically going to spread your liquidity uniformly across those bins. So it's not going to ask you how much you want to provide to each bin. It's going to say, you give me a dollar amount, and I'm going to give you how much ETH to provide, implicitly assuming that it's you. So when you look at the data, you see all of these rectangle blocks of liquidity, and it's basically a clear indicator that they're using the interface, which probably is not optimal, but it's much harder to build your own transaction that has multiple calls to the smart contract than it is to just use the interface, right? But I think that's also some identification potential, right, for figuring out who these unsophisticated investors are and figuring out if everybody else maybe is sophisticated or not. Yeah.
I'm thinking you have an equation where you said the expected risk-adjusted returns equal to the exponential of the risk-free rate. I'm thinking, is this what pins down the risk-neutral measure Q, or that's how you identify Q, right, by this equation?
Yes.
Okay, see, or it's the other way around. You postulate the existence of a Q, and then it turns out that under this risk-neutral measure, you end up with this exact relation. So I was thinking how should we mean what?
So basically the risk-neutral measure is pinned down by the model of the Brownian motion, but this is
and then it turns out that under that risk-neutral measure, that expression, this equality holds.
Yeah, I mean, this is your no arbitrage condition.
I see. Right. So you said it. That's the no arbitrage condition.
Yeah. So like, if you're risk neutral, that's exactly what you're going to do. If you are risk averse, there might be some modifications, but at the end of the day, the optimization is going to be the same, and so you're going to get sort of a similar distribution of liquidity provision.
Okay.
So could you explain a little bit more the relationship to the covered call? Like the portfolio I would get out of one of these spins, is it exactly like the return distribution a covered call would give me?
So it's not exactly, but the numerator is that payoff. So the numerator here, basically because the denominator is like how much capital you're providing, but the numerator is exactly the sort of payoff from a covered call, where basically when the price trades through your bin, you're sort of selling the asset, whereas when it doesn't, the call expires worthless. But yeah, so that's why we're saying it has strong similarities. It's just this denominator term that kind of messes things up because it depends on the amount of capital you provide, which depends on the initial price when you're providing capital. Thank you.